Everyone, my name is Eric Altholz. I'm a partner in the Employee Benefits and Executive Compensation Group at Verrill, and my colleague Bill Jewett and I are pleased that you can join us this morning for Executive Compensation 101, the basics. Just a little information about us. As I mentioned, Bill and I are partners in the Employee Benefits and Executive Compensation Group. Bill is in our Boston office. I'm up here in beautiful Portland, Maine. And we are pleased that you're choosing to spend an hour of your time this morning with us. Our goal this morning is to provide a very basic, high-level introduction to what is a complex and interesting topic. And we just want to allow you, as a takeaway, to think in more concrete terms about how a well-designed executive compensation program can help reward your key employees, help retain them as well. And then, of course, the overall goal is to help move your organization forward by doing those things. There is a link to our slide deck that's been posted in the chat window. And I want to say to our technical people who are with us, I don't see the chat window on my screen because I'm sharing my screen, but I assume the chat window is up there.
It's there.
It is there. Thank you, Bill.
And good morning, everyone.
and actually, that may affect how we proceed with questions here. So I was just about to say that we encourage you to add questions to the chat panel, and we will keep track of those questions. And if there's something that seems particularly urgent, we will pause the presentation and address that question. Otherwise, we're going to try to save them up and address initial questions at the end of what is essentially the first half of the presentation, and then save the others for the other half. I want to mention that as you see on the screen, our contact information is right there on the cover sheet. And if we don't get to your question, or if questions occur to you after the program, feel free to email Bill or me, and we'll be happy to answer those questions. Unless there's anything else, Jillian, Ann, Rachel, or Bill, I think we will proceed. There we go. So, as I mentioned, our goal is simply to provide a very high-level overview of some common approaches to designing executive compensation programs for key employees, and explain the federal income tax rules that govern those programs. That's the key focus. We're going to start with income tax rules and also the ways in which ERISA affects these types of programs. And I'm going to take that half of the presentation, and then Bill will take over and talk about specific types of executive compensation programs that are quite common in a variety of settings. As I mentioned, it's a complex area, and to make the topic a bit easier to present and digest, we're going to try to narrow the scope of the conversation or the presentation by assuming that each of you, that every employer that we're addressing here is a privately held for-profit corporation, and specifically as a subchapter C corporation, so a regular garden variety corporation. All of the programs, or most of the programs that we're talking about, can apply to other corporate forms as well, S corporations, partnerships, LLCs, but those corporate forms introduce additional complexity and also additional opportunities that make it that we sort of go beyond the scope of this conversation. So if any of you attending or have an entity that is in one of those alternative forms, also tax-exempt employers, where we're not going to focus on them very much, this presentation will still be useful to you, but you may find that you have additional questions, and as I said, we can answer those at another time. So we're really assuming a regular C corporation, privately held, and proceeding on that basis. So when we begin to work, particularly with a new client, we really like to start by asking some key questions and by listening carefully to the answers that the client provides. The answers to these questions really help focus the analysis and probably help narrow the range of appropriate opportunities or appropriate designs for an executive compensation program. And in all cases, it certainly will help improve the outcome and the product that you get and make it a much more efficient process. So there are many questions that we could ask, but we would tend to focus on these. First, what are the overall compensation goals and compensation philosophies of your corporate or of your corporation? Is there a lot of compression? Do you tend to reward really high performers in extremely high ways, or is it more modest? So do you have goals about that? Who are your key employees and your key executives? Who are the folks who really make the place run and move forward? The people that you really can't live without or would really struggle to replace. What organizational goals do you want to promote through the program? Is it really trying to encourage specific behaviors, or is it just rewarding a whole wide variety of good behaviors that help the organization move forward? So for example, a program focused on sales folks might be very different than a program that's focused more on internal financial people who do other important things but don't directly add to the bottom line. Are there real or perceived gaps in your executive compensation arrangements? Many of our clients work with compensation consultants that'll do a 360-degree comp study and compare the compensation arrangements with those of comparable organizations. So if you've worked with a consultant who's saying, well, you're falling behind, or most organizations like yours offer a stock option plan and you don't, then that certainly is going to inform the thinking about the program. And then finally, is there a time frame that's important here? Is there a limited time frame in particular? Are you getting the company ready for sale, either this year or in 2 or 3 years? That turns out to be very important, because you will not only want to reward folks who are there at the time of the sale, but you're going to want to make sure your excellent management team stays around and it continues to add to the value of the company. So we could go on and on with these questions, but we think these 5 really capture what you should be, the place where you should begin thinking about the program. So with that introduction out of the way, we really meant it when we called this program Executive Compensation 101. We're really starting and really limiting ourselves to the most basic tax rules. And so here on this slide, we're just summarizing the most basic one. So cash compensation, the most typical form of compensation, is going to be taxable to the employee for the year in which it is received. That's typically going to be the year in which it's paid, although I guess not always if you have a pay period that crosses a calendar year. That's cash, and everyone knows that. But property can also be transferred as a form of compensation. So if you transfer stock or other property to an employee in exchange for services, that stock or other property is going to be taxable based on its fair market value at the time of the transfer, as though it were paid in cash. So a $10,000 cash bonus and a $10,000 stock bonus, that is a bonus paid in stock that's worth $10,000, they are taxed in exactly the same way for income tax purposes. And then finally, employers take tax deductions for compensation in the same year in which the employee is taxed on the compensation, at least as a general matter. And we'll, we can talk about tax accounting another time, but that's going to be our operating assumption. Now that was probably the easiest slide, and we'll start to dial up the complexity just a little bit now. So having talked about cash and current transfers of property, there's certain types of compensation that are governed by special rules. So equity-based compensation, including stock options and restricted stock, which Bill is going to talk about later, are subject to some special rules. And then, of course, deferred compensation, where we're going to spend a lot of our time today, is also subject to special rules. And that's, in a nutshell, compensation that's going to be paid in the future for services that are performed today, or potentially in the future, but the deferred comp will be paid at some time in the future. Now, I want to note here that we're focusing on income taxes today. And as you all know, as employers, FICA taxes also apply, and there is yet another special rule that applies to FICA taxes. FICA taxes apply earlier than income taxes when there's a difference in time between vesting and payment. So FICA taxes are paid on vested deferred compensation even before income tax is paid. So we're talking about, when we talk about deferred compensation, we're deferring income taxes first and foremost, and possibly or probably not the FICA taxes. We won't say more about that today, but it's something to keep in mind. So from a tax standpoint, if you take nothing else from this presentation, you will remember this, that Code Section 409A, that's Section 409A of the Internal Revenue Code of 1986, governs most deferred compensation arrangements. Section 409A is not new, although for those of us who've been doing this for a long time, it still in some cases feels new. It came into the Internal Revenue Code in 2005 and codified many, many years of IRS rulings and guidance, formal and informal, about deferred compensation plans. So this was an attempt to really bring order to the universe of deferred compensation. And it is a very complex and broad set of rules. Basically, Section 409A does this. It provides a very broad definition of deferred compensation and what is a deferred compensation plan. It establishes very strict rules governing voluntary deferrals, so salary deferral elections made by employees, as well as payment elections, so the time and form when the payment of the deferred compensation will be made. It restricts the time when payments can be made and actually prescribes a specified list of permissible payment events, and deferred comp may only be paid upon the occurrence of one of those events. And finally, creates formal requirements that must be satisfied through written terms, a written plan document. And by formal requirements, we mean literally requirements as to the form of the document, the language used in the document, the words on the page that must align with the requirements of Section 409A. Really, Section 409A is about the time and form of payment rather than the amount of the payment. And I think when you hear Bill talk about the specific forms of deferred comp and other comp, you'll get a better sense of that. And by form of payment, I should say, I mean literally, is it a lump sum or installments, things like that. So time and form are key for compliance with Section 409A. So what is deferred compensation? Deferred compensation is essentially a promise that is made today to pay compensation in the future. And what Section 409A says, in a somewhat more complex formulation of that simple concept, is that a service provider, and that could be an employee or an independent contractor, obtains a legally binding right in 1 year to compensation, which is or may be payable in a later year. If that happens, then a plan provides for deferred compensation. And that's true even if there are conditions or other requirements that have to be met, such as vesting or the occurrence of other events, like a sale of the company or something like that. If a person has an enforceable right, a legally binding right to receive compensation in the future, that creates deferred compensation, and that makes us immediately think of Section 409A. Now, if the requirements of Section 409A are satisfied, then the compensation is taxed when it's paid. Just as we said on that earlier slide, cash, taxed when it's received by the employee. Same is true if you have a deferred compensation plan that complies with Section 409A. But if the requirements of Section 409A are not satisfied, then the deferred compensation will be taxable when it ceases to be subject to a substantial risk of forfeiture. And substantial risk of forfeiture is the fancy legal term for vesting. I think you're all familiar with the concept of vesting with 401k plans and other arrangements. Substantial risk of forfeiture, it means vesting. When the substantial risk of forfeiture lapses, the benefit is vested. So often, your plan is going to provide for payment in the future, but if the right to payment is vested today, and you've not complied with 409A, then that benefit is going to be taxable today. In addition, if the plan fails to comply with Section 409A, whether in its written terms or the way it's administered, a 20% additional tax may be imposed on the service provider to whom the compensation is payable. And the prospect of a 20% additional tax paid to one or more of your key employees is enough to make us pay very close attention to the design of your plan. So the consequences of failing to comply with Section 409A are quite dire, and the opportunities to correct failures are limited. Unlike what some of you may have experienced with a 401k plan, where you make an administrative error and there's a well-worn path to correction blessed by the IRS, that structure for correction does not exist in the deferred compensation world. So for the obvious reasons, we focus very intently on 409A compliance when we work with clients on deferred compensation plans. Now, as is the case with almost every tax rule you can imagine, there are exceptions, and important exceptions, exceptions that we really try hard to use when we're working on deferred compensation arrangements. The first is the short-term deferral exception. So if compensation is paid no later than 2.5 months after the end of the year in which the compensation becomes vested, it's no longer subject to substantial risk of forfeiture, then Section 409A will essentially ignore that and consider it not to be a deferral at all. And that's why, so if you look at bonus plans or many other shorter term arrangements, when you see references to a payment will be made no later than March 15th of the next calendar year, this is the rule that is driving that provision. And that plan is trying to take advantage of the short-term deferral exception, so we don't have to worry about Section 409A at all. Another very important exception that we use a lot is separation pay arrangements. So separation pay, that is the word, that's the description in Section 409A, as opposed to severance pay, which is used in other concepts, is not just any termination. So it's not just a parting gift that when someone leaves, but it must be paid in connection with an involuntary termination or a termination for good reason that is also subject to dollar limits. Essentially, the payment can't exceed 2 times the lesser of the person's annual rate of pay, or what is called the Section 401A17 limit. That is the limit on compensation that can be taken into account in determining contributions under your qualified plans, like your 401k plan. It's currently $290,000. So it can't be more than the lesser of twice those numbers, and the payments have to be completed by the end of the 2nd year following termination. So if all of those requirements are met, then Section 409A will not apply, and the separation pay exception will, and off you go without worrying about Section 409A. Finally, stock options, which Bill will talk about quite a bit, that stock options that meet certain requirements are also exempt from Section 409A. Those of you who are old enough to remember in the money stock options back in the good old days, you don't see those anymore, and the reason for that is Section 409A. One of the requirements is that the exercise price may not be less than the fair market value of the stock at the time of the grant, and in the money options typically were below that price. So it really had the effect in many ways of bringing non-qualified stock options a little bit closer to incentive stock options only for purposes of this rule. And then finally, tax qualified retirement plans such as your 401k plan, as well as deferred compensation plans of tax exempts and local governments, Section 457B plans, they are also exempt from Section 409A. Just for a moment, I'll leave this slide up. As I said, we're assuming that for purposes of our conversation today that we're talking about a for-profit C corporation, but we do want to mention if there are any tax-exempt organization folks out there that you will know that Section 457B plans are quite popular in the tax-exempt world. They are not subject to Section 409, they're specifically exempt. And they are subject to special rules that make them very useful benefits, particularly because they're exempt from 409A. And then the alternative is Section 457F, ineligible deferred compensation plans, which are not subject to any of those limitations that apply to 457B plans. Technically, they are not exempt from 409A the way 457B plans are. But when we work on those plans anyway, we typically design them to fall within the short-term deferral exception that I just mentioned. And the reason for that primarily is because the big thing to remember about section 457F is that the deferred compensation is taxed when it becomes vested. So it's all about vesting and not about payment. But for that reason, because most people don't want to be taxed before they receive their payment, we will typically structure a 457F plan to require payment within 30 or 60 days or something like that after the vesting event. So the last 10 slides or so have really focused on income tax rules governing deferred compensation arrangements in general, but we do want to mention that ERISA is relevant here. ERISA, those of you who are familiar with ERISA or have experienced ERISA, you will have experienced it within the context of your pension plan, and the ERISA definition of pension plan includes 401k plans, 403b plans, all things like that, and all tax qualified plans. But ERISA can apply even to a deferred compensation plan unless that plan meets certain requirements. And that's just because the definition of pension plan is quite broad. So we typically would, I would say always actually design deferred compensation plans to qualify for the so-called top hat plan exemption under ERISA. If certain requirements are met, then a deferred compensation plan will be exempt from almost all the requirements of ERISA. And what do we mean by top hat plan? That you actually will not find those words in the statute of ERISA, but that has been the term used for as long as I can remember. Top hat plan is a plan maintained primarily to provide deferred compensation benefits to a select group of management or highly compensated employees. There is no bright line test for that. The key things to remember is, I would say two things to remember. First, when the Department of Labor interprets that quoted sentence, they treat that as two distinct tests: select group and management or highly compensated employees. So we look at it that way. And we also know from Department of Labor guidance that when you determine your highly compensated employees, it's not as simple as just referencing the folks who would be treated as highly compensated under your 401k plan. That's the section 414Q definition. Currently, for the typical employer, assuming the employees don't own at least 5% of the stock, that's going to be people who earn $130,000 a year or did so last year. That's not enough. We will very commonly reference the 414Q definition, but add $10,000 to it or $15,000 to it, and also reference specific categories of management. So this plan will, to be eligible for this plan, you've got to make more than $10,000 over the 414Q limit, and you've got to have a position of vice president or above. That's a pretty common formulation for a top hat plan. For those of you who are inclined, we have a case site here. There's not a ton of litigation over top hat plans, but there is some, and this Sikora case provides a very nice overview of how top hat plan criteria are analyzed by federal courts. To meet the top hat plan exemption, in addition to the criteria that I described, you've got to have a plan that is unfunded, and we put that in quotes because there's some lowercase f in quotes funding arrangements such as rabbi trusts, which are quite common in the tax-exempt context. You can fund the plans in that way, but generally the requirement is that benefits must be paid out of the general assets of the employer. And those of you who are familiar with rabbi trusts will know that even if assets are transferred to a rabbi trust, they are available to satisfy the claims of your creditors in the event of insolvency or bankruptcy. So you're kind of earmarking assets, but you're not really segregating them from general assets. So that's a critical component in addition to the participation criteria that I mentioned. And then finally, you've got to file a top hat statement with the Department of Labor. Back in the day, there was a form letter that we would always send to the Department of Labor, but a number of years ago, they made the process extremely easy. using a link to on the DOL website. It'll take about 10 minutes to file your Top Hat plan statement. The statement must be filed within 120 days of when the plan is adopted or takes effect. There's some fudge factor there, but the good news is that, and this is something we see from time to time, you can't, if you have a deferred compensation plan and you've intended to make it a Top Hat plan, but you never made the Top Hat statement filing, you can make a corrective filing quickly and simply and cheaply to remedy that situation. So in a nutshell, we've really talked about the first two elements on this slide. The tax compliance, I didn't specifically reference Section 83, but that's the rule that drives the transfers of stock. When I said that the stock would be taxed at fair market value, that's the rule that drives that tax treatment, and Bill will reference a special provision of Section 83 later. Code Section 409A, where we spend a lot of our time, and the important special rules that apply to tax exempts under 457B and F. We talked about the ERISA compliance piece, making sure you have a good Top Hat group and you file your Top Hat notice. We did not talk about the third risk area, or compliance or risk assessment area, and that is litigation. That's always a risk, as we often say. You can get sued for anything. And you just want to be in a position to defend that lawsuit. The situation might involve an executive that leaves under unhappy terms and feels that he or she is entitled to a deferred comp payment that is being withheld. So we do think about litigation, and a well-drafted plan document is going to help you avoid that by avoiding ambiguous terms, by making the benefits clear, by reserving to the employer the right to amend the plan at any time, by reserving to the administrator the ability to interpret the plan. All those kinds of things would be parts of a well-drafted plan document. And then finally, with equity-based compensation, there can sometimes be valuation issues. And then finally, a challenge to Top Hat status, either by an aggrieved employee or potentially by the Department of Labor. So that goes beyond the scope of the presentation today, but we do want you to be mindful of the importance of having a well-drafted plan that's properly administered to help you limit your litigation risk. So let's see, that is my last slide. Are there questions in the chat room?
We do have one question going back to the tax rules, and specifically to the rule about FICA being payable at vesting. So Social Security and Medicare being payable at vesting. And the question is it payable both by the employer and the employee at vesting?
Yes. That's Bill, unless you have a different answer to that.
No, that's correct. In spite of the fact that the employee is not necessarily going to have liquidity to pay those employment taxes unless the award pays out at the same time.
Okay, and now, yep, and now I can see that. Maybe I can move this window. Let's see, and I can. All right. Now I can see the chat window and the slides. And Bill Jewett, you are up.
Great. So we're a little more than halfway, I think, through. So we'll have kind of a whirlwind tour of various types of executive compensation. Essentially, we'll talk about three types. First, simplest, cash payments and promises of cash payments, which is to say incentive plans. Second, equity-based compensation, so stock compensation. And finally, other arrangements such as retirement benefits, special health benefits, insurance benefits, and so forth. So this is a seminar on the basics. So here's a basic question. Why are there special arrangements for compensating key executives? And there are a couple of quick answers to that. One is to attract and retain the best talent. And a second is to incentivize that talent to perform and do their best. Current cash compensation addresses those needs to a certain extent, but it does not necessarily align key employee incentives with the company's long-term goals. The key employee might say to himself, yeah, I'll get a raise if I perform well, but that's a pretty vague connection to company performance. Also, current cash compensation provides only a limited inducement to stay with the company over an extended period. If you stay, you continue to get your salary, but that's really the only retention hook that salary has. So packages focused on salary are really better suited to rank and file or middle management employees than to executives. So one way to add on top of salary and address some of these needs a little bit better is paying bonuses. You get some impact with bonuses for retention and incentivizing performance, but discretionary bonuses provide only a limited incentive because the criteria are often unstated or too subjective. And basically a reward for prior work is not the same as an inducement to meet articulated goals. And for that reason, to address these needs a little bit better, many companies maintain incentive plans. And there are basically two kinds that we'll talk about. One is an annual incentive plan. The second is a long-term incentive plan. Here's an example of an annual incentive plan. Plan will inform the executive, you will get a bonus equal to X% of your salary if we hit all of the following targets for the year. And you'll get a bonus of 2 times X if we hit these maximum targets for the year, these stretch goals for the year. But if we don't meet minimum thresholds, you will get nothing. So that's the program, and in between, there will be a range of possible bonuses that you'll get. Here, payment is tied to achievement of short-term goals intended to be achieved within a single year. The goals can combine company-wide financial goals, EBITDA goals, for example, stock price goals, with individual or divisional goals. So you might have personal goals be 40% of the CFO's annual incentive target, and company or budgeting goals be 60% of the award. The CFO typically has 100% of his award determined based on company goals. So annual incentive plan awards are paid out on an annual basis, typically at the beginning of the next year, and almost always by March 15th of the next year, in order to make these short-term deferrals and keep them outside of Section 409A. Another design that's very common is the bonus will only be paid if the employee continues to be employed on the payment date. And that likewise keeps the incentive award outside of Section 409A. So long-term incentive plans are a little bit different. They are tied to longer-term goals, typically a 3 to 5 year horizon. They're paid out after the end of the performance period or after achievement of specified company goals, such as, our company's vaccine receives FDA approval, you will get your long-term incentive plan bonus at that point. You can have successive performance periods or even overlapping performance periods. You could have 3-year periods, a new one starting each year. And some plans include vesting features or provide for payouts over future performance periods. So just to give you an example of this, a plan might have some percentage of the person's annual incentive plan bonus deferred and set up so that it vests over a 3-year period, 1/3 in the first year, 1/3 in the second year, 1/3 in the third year. And the value of that deferral could be set up to vary in order to reflect some performance metric. Maybe it would vary in accordance with the value of the company stock or some other financial measure. With nonprofits, often you'll have something like a deferred bonus will vary to reflect the performance of the institution's endowment over time. So notice here that if you want to reflect company value in the value of your award, you have to put in a special design feature like the one I just described. But there is, of course, a simpler way to do this to capture company value in your incentive awards, and that is to award equity-based compensation. So equity-based compensation essentially uses company stock, either directly or indirectly, to pay or measure incentive compensation or deferred compensation. And some common examples we'll discuss are stock bonuses, just handing over a number of shares. Restricted stock, which is essentially the same but with restrictions so that you have to earn the bonus. Stock options, and then various other arrangements, phantom stock, stock appreciation rights, and restricted stock units. And these types of equity-based compensation can work also with companies that don't issue stock, so LLCs or partnerships. You can have LLC unit bonuses or restricted unit programs, or even stock options that are really unit options where you have a right to purchase LLC units in the future. And in addition, I'll just mention that LLCs and partnerships can also award so-called profits interests, which are like stock, except that they're worth nothing at the time of grant because they represent an interest only in profits of the company going forward after the date of grant. So essentially the grant date value is 0, but down the road, a profits interest may be worth quite a lot. Any of these types of equity-based compensation can include an element of retention, that is to say vesting, and the elements can be, or the different types can be mixed and matched for different employee classes. You might want some of your employees to be shareholders and others of your employees not to be shareholders. Or maybe some of your employees are accredited investors for securities law purposes, which is to say, typically it would be because they have $1 million or more in net worth, setting aside their house. And other employees may not be accredited investors, and you might worry about having a securities law exemption for giving them actual equity. So you might give them phantom equity. Starting with the simplest form, stock bonuses. This is essentially paying a bonus in the form of stock. And this is, as Eric said, treated the same as a cash bonus for tax purposes. This can be totally discretionary, same as a cash bonus. The tax treatment is fair market value of the stock is taxed in the year of the award. And importantly, taxes must be withheld from the employee's cash compensation because, of course, they're not getting any cash in the stock bonus to pay their taxes. And an alternative to that, of course, is that the employer can pay the taxes for the employee, but this gets very expensive very fast because paying the employee's taxes is additional compensation to the employee, which is also taxable, and paying those taxes is additional compensation to the employee, and so on. It adds up quite quickly. So disadvantages of stock bonuses, they don't really have an element of retention, other than the fact that somebody who holds stock in the company is going to be loyal to the company, presumably in which he holds stock. Also, there's no real skin in the game for the executive. In other words, the employee doesn't come out of pocket at all unless he's paying the taxes, doesn't put his or her own resources at stake in this type of award. These disadvantages can be addressed by adding restrictions to a stock bonus, and if you do that, you have essentially restricted stock. Restricted stock is the same as a stock bonus, but the right to full ownership of the stock vests over time. So just to give you some examples, you can give someone an award of 100 shares in 2021, with 25 shares vesting each year from 2022 through 2025. And that would be so-called graded vesting or gradual vesting over 4 years. Or you might give somebody an award of 50 shares in 2021, all vesting all at once 3 years later. That's so-called cliff vesting, because if you draw the graph of how much the person is vested, you just have a cliff out at 3 years. The key here is that the employee must remain employed by the company in order to gain a full ownership interest. And this is what gives you the retention hook. It also has the effect of delaying taxes, which we'll talk about momentarily. But I just want to emphasize also that it is possible to apply certain restrictions even after the restricted stock vests. So for example, you could have the company retain a right to repurchase the stock if the employee leaves the company. That is very common. So the tax treatment of restricted stock, next slide. Income and employment taxes apply in each vesting year based on the fair market value of the stock that vests in that year. So just again, an example, year 1, 25 shares vest and the fair market value of the stock is $10 per share. The employee is taxed on 25 times $10 or $250 of compensation income. Year 2, another 25 shares vest and the fair market value of the stock is $14. The employee is taxed on 25 times $14, which is $350 of compensation income, all at probably the highest marginal rate, currently 37%. However, and this is key for restricted stock, the employee can make a special tax election to accelerate taxation of the full award in the year the award is made, based on the fair market value of the stock at that time. This is the so-called 83B election, and Eric mentioned or referred to this quickly earlier. This is a very useful election to make, a good idea to make this election if the stock value is initially very low, but is expected to increase. So for example, if your company is a startup company and the stock is worth very little at the outset, you may well want to make an 83B election and just pay all the taxes up front, in which case you won't be taxed again as the award vests. And the award, the stock might be worth more as the award vests, and you will have saved yourself some taxes by offering to pay the taxes up front. And this is especially useful in the case of profits interests, where the upfront value of the profits interest will, if you satisfy certain requirements, be 0. So you can pay tax at a 37% rate on 0 and not be taxed as the profits interest vests, which is a pretty good deal. So you may be asking, is there a way to provide equity-based compensation that isn't taxed at grant or at vesting? And the answer is yes. You can provide stock options. A stock option is basically a right to purchase stock at a specified price, so-called exercise price, sometimes called the strike price, either at a certain time or after a certain time. And there are 2 basic kinds of stock options we'll talk about that are used for compensation, so-called incentive stock options, which are a creature of the tax code, and so-called non-qualified stock options, which is everything else. The option holder typically pays the exercise price in cash, but the exercise price can also be paid in stock that the employee already owns. It's also possible, but more complicated, to have a so-called cashless exercise or a net exercise, in which case the exercise price is essentially paid by holding back shares that otherwise would be delivered to the option holder when he exercises. So, and the fair market value of those shares is applied toward the exercise price and toward the taxes that are owed. Just to note it, cashless exercise and net exercise are often not used because there are negative accounting consequences to having those features. So incentive stock options, what are they? Well, they're options as provided for in section 421 and 422 of the tax code. They have to meet certain requirements, including requirements for shareholder approval. There are limits on the number of shares that can be subject to grant. Essentially, the limit is $100,000 worth of options per year per employee based on the value of the stock at the time of grant. Notice that I said employee. These are available only to employees, not to consultants or advisors. Incentive stock options must have an exercise price that's not less than fair market value of the company's stock as of the grant date. And in the case of a grantee that is a 10% shareholder of the company, the exercise price must be not less than 110% of fair market value as of the grant date. The plan and the options have to have a limited lifespan. The limit is 10 years. You can have vesting requirements if you want, and vesting is very typical. And what is all this for? What's the sizzle here? Well, you get favorable tax treatment if you satisfy certain requirements when you exercise an incentive stock option. The treatment is there's no income tax upon grant of the option or upon the exercise of the option, and you get capital gain treatment on sale of the stock when you ultimately dispose of it. However, to get that treatment, it is necessary to hold the stock after exercising for at least 1 year, or the code says more than 1 year, and also more than 2 years from the date of grant of the option. If you get rid of the stock before those dates, you don't get this favorable tax treatment. Essentially, you end up with a non-qualified stock option. Just a couple other quick points about incentive stock options. There's no FICA on exercising an incentive stock option, which is a good bonus, so no employment taxes. However, the spread on an incentive stock option is included in your alternative minimum taxable income if you happen to be in the AMT. So non-qualified stock options are basically everything else that doesn't qualify as an ISO. Section 409A essentially eliminated in the money NSOs. So again, the exercise price has to be not less than fair market value of the stock on the grant date, but there's no 110% requirement for the 10% shareholders. There's greater flexibility regarding the lifespan of the option. It can be 12 years, can be 20 years if you want, although that's very atypical. Again, 10 years is quite typical. And the tax treatment is less favorable than with ISOs. The employee has ordinary income at exercise equal to the fair market value of the stock minus the exercise price. And then when the stock is sold, the rest, if there's any gain on top of that, is capital gain at the lower capital gain rate. So phantom stock, SIRs, and RSUs, just to wrap up equity-based compensation. What is phantom stock? A phantom stock program provides for a cash payment determined by reference to the appreciation in the value of the company's stock over a period of time. So for example, an employee receives 300 phantom shares when the stock is worth $8 per share. Will be eligible for payout after 3 years if he's still employed. On that payout date, the value of the stock is, let's say, $10.50, a gain of $2.50 per share. The employee will receive a cash payment of $750. Essentially, you can see economically, this is very much like a stock option because it captures the upside on the stock. The difference is, well, 2 main differences. There's no optionality. You don't get to pick and choose when you're going to get paid. And second, this isn't a security. You don't hold actual shares. Phantom stock can vest and pay gradually, or it can vest and pay all at once when the company achieves a certain financial goal. And tax treatment, the employee is taxed at the time of payment, and the phantom shares expire at the same time. Stock appreciation rights, not very commonly used. They're similar to phantom stock, but usually they pay out in stock. Also, they can have an exercise feature like a stock option. Restricted stock units, last but not least, because these are in fact very, very popular. Restricted stock units are a promise to pay stock in the future. usually at vesting. So restricted stock, just to distinguish it from restricted stock units, restricted stock, you would transfer the stock to the employee subject to restrictions so that the right to keep the stock has to be earned. Restricted stock units, you give the employee a contract, a letter, some kind of agreement saying, we will transfer stock to you at a later date if you satisfy the following requirements. So that's the structural difference. Restricted stock units are, as I say, very common. One favorable feature of them is that there is no tax until settlement, until the shares are actually delivered.
Bill, let me jump in with a very quick comment just about the SARs, stock appreciation rights. We know the SARs are very commonly issued in connection with ESOPs. And in those cases, particularly if it's 100% ESOP company, they're going to be paid in cash, not stock. So we're aware of that. Just wanted to round out that comment. But in the classic, particularly in connection with other options and things like that, it's very common to see stock payments as well. Sorry about that.
Yeah, thank you, Eric. That's helpful. So just moving on to some other arrangements, and we'll try to wrap this up quickly because I think we have a few questions. Change in control agreements are fairly common executive arrangements. Typically, they're designed to retain the services of key employees through a sale of the company, and then to pay out a separation benefit or a so-called golden parachute benefit. And just one important concern with these arrangements is that they are potentially subject to excise taxes. Tax Code Section 280G imposes an excise tax if your golden parachute benefit is valued at more than 3 times your average compensation over the past 5 years. So that can be a very expensive excise tax, and there are various ways to design around Section 280G, but it's an important concern to keep in mind. More broadly, there are separation pay arrangements. Eric touched on these before, so no need to go into them in great detail. They're designed to protect key employees in the event of a termination without cause. And as Eric said, they need to be designed to meet certain criteria, certain requirements to keep them outside of Section 409A. And those details are back on slide 10. Finally, just an assortment of other arrangements. There are supplemental executive retirement plans, which are essentially retirement plans that go over and above what the tax qualified ERISA plans provide. So you can have a defined benefit style SERP, supplemental executive retirement plan. That might be something like a promise. And I say, when I say promise, you should be thinking deferred compensation. These are subject to 409A, and that is the case. A promise of an annuity for life starting at retirement age equal in value to 5% of your final average pay per year of service with the company. You'll typically have a very complicated formula like that, which will end up with a life annuity that's fairly valuable. That's a defined benefit SERP. You could have a defined contribution SERP where the contribution is what is promised. So we will put into an account, or we'll credit you with $100,000 each year, increasing for inflation by 3% per year, and we'll give you 3% interest on that account, and it's all going to be payable at your retirement. That would be a defined contribution SERP. Or you could have a combination of these two, a hybrid target benefit SERP, and this might look something like the following. We will credit to an account an amount each year that would be enough to fund that defined benefit that I described earlier, that annuity for life starting at retirement. And when you get to retirement, we're not going to buy you an annuity. We're just going to give you what's in the account in a lump sum or in installments over time. That's a possibility. So there are also so-called excess benefit plans, which are essentially deferred compensation plans that are designed to give an executive benefits over and above what can be provided, given that the IRS limits the amount of compensation that can be taken into account under tax qualified retirement plans. So this might be something like, we will make a contribution, or we'll credit you in an account with an amount each year equal to the company matching contribution that you would have gotten under the 401k plan if the IRS didn't limit the amount of compensation that can be taken into account. And then we'll give you that benefit minus whatever the benefit is that you get under the 401k plan. And similarly, this can be done with defined benefits. And again, these deferred compensation arrangements can be supported by a rabbi trust, so-called because the first trust of this kind was set up by a congregation for its rabbi. This would be a trust in which the funds are set aside for the benefit, but are still available to the creditors of the company in the event of insolvency. So just a few executive health and welfare benefits that are popular. Executive physicals are quite popular. Ordinarily, it is forbidden to provide company-funded health benefits on a discriminatory basis, only to your highly compensated employees. But there's an exception in the regulations for medical diagnostic procedures, which includes annual physicals. Just a couple of insurance benefits. Split dollar life insurance is somewhat popular and used to be very popular. This is life insurance where essentially the company pays the premiums and the employee enjoys the benefit. There are essentially two species of split dollar, one of which has the employer own the policy and just assign to the employee certain benefits like the value of the coverage. Here in this model, the employee is taxed on the economic benefit that he gets. The other model has the employee own the policy, but the employer paying the premiums through a loan to the employee, which is then repaid out of the proceeds of the insurance at the end of the day. Finally, well, two more items. Fully paid medical insurance for executives is possible, but under Obamacare, if it's awarded on a discriminatory basis, there is technically a penalty of $100 a day for each employee in the company, up to $500,000 a year. And I say technically there is this penalty because the IRS came out in 2010 or 2011 with a notice saying, until further notice, we're not going to enforce this penalty. But that might always change. Finally, executive long-term disability policies are common because typically a company's long-term disability policy is capped at a very low, well, a relatively low salary, and capped at, for example, 60% of that relatively low salary. You might want to give an executive full salary replacement coverage on disability. You may also want to provide disability benefits if the executive is unable to do the executive's job, rather than having to be unable to do any job at all. So that is the whirlwind tour of various types of executive compensation. Eric, do we have questions?
We do. We have 4 questions, and we're going to try to answer them in 2 minutes. The first, I made notes, but okay. So the first question is a clever one. The questioner asks whether it's possible, I keep scrolling past this, I'm sorry, Vin. whether in a loan, so let's say there's a rabbi trust and a corporation is negotiating terms of a loan, and the question is, what if you could actually get the lender to agree not to look to the rabbi trust as a source for satisfying the debt obligation, Presumably this would be in the event of the bankruptcy or insolvency of the corporation. And would this be problematic? Would this frustrate the deferred comp plan or create a problem in the eyes of the IRS? So that is a very clever idea. It's not something that I've seen done. Certainly the assets in the rabbi trust would continue to be available to all of your other creditors in the event of the insolvency or bankruptcy. But honestly, I'd be a little nervous about that. I'd be a little nervous about anything that appears to limit access to the rabbi trust assets. It just feels like you're segregating those assets from the general assets of the employer, even though in your example, it's really a segregation of assets only as to a single lender. So I don't love that idea, but honestly, I've not seen it done, and I'm not prepared to tell you that the IRS would blow out the whole plan because of a single limitation and a single loan. But I don't know. Bill, is that?
Yeah, I would say you're doing very well with your bank if you can get them to agree to that.
Yeah.
So all good, so far so good. But if it's in writing, I think on audit, the IRS would say, well, that's part of the terms of the rabbi trust, and it fails our criteria for a rabbi trust, and you actually have a funded arrangement, which would be kind of a disaster.
Yeah. Stephen Song, can the company paid taxes? So this is I think the situation where we're going to pay a stock bonus and then gross up, either pay a bonus on top of that or a full gross up where we're paying taxes on the taxes, as Bill said. Could that be basically clawed back or characterized as a form of a loan that would be repaid on the sale of the stock? That's another, everyone's coming up with clever ideas. I've also not seen that done. I suppose you could do that or have just a clawback. I might be reluctant to treat it as a loan because for it to be a legitimate loan for tax purposes, you'd have to either charge at least the applicable federal rate of interest on the loan to treat it as a real loan, or you'd have to be imputing income to the employee whose taxes you paid. And the other thing is, if you really want to make it a loan, you'd want to document it with a promissory note and all of that. So is it possible? I suppose it's possible. It's just it's a more elaborate, secure form of a clawback, but I think you'd want to be attentive to the terms of the loan if you really want it to be a good loan.
So also the IRS has addressed this kind of arrangement in regulations. So it could be pretty complicated. Specifically, they've addressed the case where somebody isn't given restricted stock, but in fact buys the restricted stock with a loan from the company that is collectible only on a recourse basis out of the proceeds of the stock. And the IRS, what they have to say about this is that's essentially an option because, well, for various reasons, but the employee really only has a stake in the upside of the corporation's stock value in that case. And they say we will tax that as an option rather than as restricted stock, which could be unfavorable depending on the facts and circumstances.
And I think I skipped one, Bill. So here's one. I think you mentioned this, but are LLC profits interests eligible for Section 83B election?
So the IRS has come out with revenue procedures saying, hey, if you meet certain requirements, you don't have to make an 83B election. You just won't be taxed up front. However, it's quite common and often required by the company that's granting the profits interest to make the 83B election on a protective basis. So the answer is yes, you can make an 83B election, and often an 83B election is made.
And then finally, so this is a question involving 100%. So an S corporation that's 100% owned by an ESOP. Is it possible that the basis for phantom stock could be zero, even though the share value is much higher than that? So I'm interpreting that to mean that you're issuing phantom shares, but the value of the phantom shares is not tied to the value of the stock actually held by the ESOP. Yet another thing I've not seen done. I suppose you could have, I have never seen phantom stock that is tied to value other than actual stock of the company. And there's lots of good reasons for that. One is it's easy to determine the value. Two is that you're really trying to mimic the effect of stock ownership. So you're giving the person the economic value of, or to some extent, the economic value of the stock ownership. So if you depart from that, then then you're losing that connection. I don't know if the question is, when you're saying basis, if you really literally mean basis the way stock would have a basis. Phantom stock itself would not have basis in the traditional sense of the starting point to determine capital gain if you dispose of it. Phantom shares really are paid out in cash. So there's no question of basis. The person is going to be taxed on the cash they receive when the phantom shares are paid out. So I don't see a basis there, but Bill may have a.
Yeah, if the question is trying to get at the question of whether you can have an award that is tied to the full value of the stock, not just to the appreciation in the stock, the answer is yes. You can do that, and we have seen that with ESOP-owned companies where there are phantom shares that are worth the same as actual shares, but when they pay, they are ordinary income rather than capital gain.
Peter, if you're still, there's one person left, so I think no, 27 people left. Peter, if you're still on, and neither Bill nor I have managed to answer your question, which is entirely possible, please just email one of us and or give us a call, and we'll try to do a better job. We are at 7 minutes past the appointed ending time. I want to thank you all again for listening this morning. We hope that this 101 level introduction to executive comp has been helpful to you. If there are further questions, you can email either one of us. If there are issues that you'd like to see us address in a future webinar like this, either a deeper dive into one of the executive compensation approaches that we've described, or more information about Section 409A, or something like that, let us know, because we are always looking for topics and interested in providing information that you will find useful. Thanks very much.
Thanks. Bye.